Hey guys, I'm here to tell you that understanding the stock market is crucial for your financial future, and it's easier than you think. You might be wondering, why should I care about stocks? Well, let me introduce you to Aaron. Aaron's story is going to blow your mind and show you why investing is so important. So, grab a seat and let's get into the world of stocks and how they can totally change your financial game. Okay, so let's talk about Aaron. This guy started investing $400 a month in his 401k back in 1981. Now, you might think, big deal, right? But here's the kicker. By 2020, that money had grown to over $1.7 million. That's the power of long-term investing, you guys. It's not about getting rich quick, it's about consistency and time in the market. The S&P 500, which is like the report card for the biggest US companies, has given an average return of 6.9% per year after inflation since 1920. That's huge! It means your money isn't just sitting there, it's working hard for you, beating inflation, and growing your wealth over time. Alright, let's get into what a stock actually is. When you buy a stock, you're not just throwing money at some abstract concept, you're literally buying a piece of a company. It's like you're becoming a mini owner of that business. Cool, right? So when people talk about owning shares of Apple or Netflix, they actually own a tiny slice of those companies. But here's the thing about money, and why investing matters so much. Since 1913, the purchasing power of $1 has been shrinking like crazy. What you could buy for $1 back then would cost you about $26 today. That's why just saving isn't enough. You need your money to grow faster than inflation eats it away, and that's where stocks come in. Now let's talk about where all this stock magic happens. You've probably heard of the New York Stock Exchange, NYSE, and NASDAQ. These are like the big malls where stocks are bought and sold. The NYSE is the oldest and most famous, while NASDAQ is known for tech companies. But how do we keep track of how all these stocks are doing? That's where indices come in. You've got the Dow Jones, which looks at 30 big companies, the S&P 500, which tracks 500 large US companies, and the NASDAQ Composite, which includes a ton of tech stocks. These indices are like the weather report for the stock market. When people say, the market is up, they're usually talking about one of these indices. So, how do stocks actually make you money? There are two main ways, appreciation and dividends. Appreciation is when the stock price goes up. This happens when a company is doing well, or when people think it will do well in the future. It's like how a house can become more valuable over time. But what makes the whole market grow? It's not magic, you guys. It's stuff like productivity improvements, cool new inventions, companies expanding globally, and more people being born and buying stuff. All of these things help companies make more money, which can drive stock prices up. And remember, as an investor, you get to ride that wave. Let's talk about the difference between stocks and bonds, because this is important. We know stocks are about ownership, right? But bonds are different. When you buy a bond, you're basically lending money to a company or the government. It's like being the bank instead of the business owner. Bonds are generally considered safer than stocks because you're promised a specific return. But here's the catch. That safety usually means lower returns over the long run. It's a trade-off. Stocks are riskier in the short term, but they've historically provided better returns over long periods. That's why most people have a mix of both in their investment portfolio. Okay, so you're ready to start investing, but where do you put your money? There are a few different types of accounts you should know about. First, there's your basic taxable account. It's like a regular savings account, but for investments. You can buy and sell whenever you want, but you'll pay taxes on your gains. Then there are tax-advantaged accounts like traditional and Roth IRAs and 401ks. These are special accounts designed for retirement savings. With a traditional IRA or 401k, you get a tax break now but pay taxes when you withdraw the money in retirement. A Roth IRA is the opposite. You pay taxes now, but your money grows tax-free. Each has its pros and cons, so it's worth learning about them. Now let's talk strategy. There are two main approaches to investing, passive and active. Passive investing is like being the tortoise in the race, slow and steady. This usually means buying index funds or ETFs that track the whole market or a big chunk of it. Active investing, on the other hand, is more like being the hare. It involves picking individual stocks or actively managed funds, trying to outperform the market. It can be exciting, but here's the truth. Most active investors don't beat the market over the long term. That's why many experts recommend a mostly passive approach for most people. It's simpler, usually cheaper, and often more effective. Let's talk about something that scares a lot of people: market volatility. The stock market doesn't just go up in a straight line, it has its ups and downs. The key is to keep a long-term perspective. Historically, the market has always recovered. That's why panic selling during a downturn can be such a bad move. Remember Aaron? His success came from staying invested through good times and bad. Alright, let's wrap this up by talking about some common mistakes to avoid. Instead of trying to time the market, consider using a strategy called dollar-cost averaging. Don't let your emotions drive your investing decisions. Fear and greed can lead to bad choices. Pay attention to fees. High fees can eat into your returns over time, so look for low-cost options. So there you have it, guys. The stock market isn't some mysterious force. It's a powerful tool that can help you build wealth over time. Remember, investing is a marathon, not a sprint. Start early, stay consistent, and keep learning. Your future self will thank you for taking control of your finances today. Thank you for watching. Please like and subscribe if this video added any value to your financial future. Stay tuned for more.